Welcome to Markets Today. I'm your host, Mbitha Mwema. With us in studio via video call is Mr. Reginald Kadzutu. He is the project head for Mass and Wider Markets Pension at Zamara. Welcome to the show, Reginald.
Thank you, Mbitha.
There's a lot that's happening that's potentially going to affect the NSE. We've seen Equity Bank rescind a decision to pay out a dividend. We've also seen the Kenya Airways numbers coming out with a reported loss of about 13 billion. We've seen Standard Chartered come out and say it's also postponing the payment of its 50 shillings per share dividend that was due on the 28th of May. There are a lot of decisions that are coming through. Kindly, would you be able to help us understand the context of this and whether there's any linkage to what is happening in COVID?
Okay, maybe I can start with the banking sector. During this COVID period, a lot of restructuring of loans has taken place, and many directives that have come from central bank for them not to punish guys who are not or guys who are defaulting, but to give moratoriums and to restructure those loans and those products. So one thing that we need to understand is that when you look at a bank's balance sheet, the largest item on a bank's balance sheet in terms of assets is actually their loans and advances. So if we use KCB, for example, KCB has a balance sheet of close to 768 billion. Of that 768 billion, 465 or 466 billion is actually loans and advances. So if a bank then has to give a moratorium on even 50% of its loan book or 25% of its loan book, that's it's literally giving cutting income from your interest generating assets by 25% and 50%. So if you then switch to the P&L side of a bank's financial statements, the largest item, for example, for KCB, is the interest on loans and advances, which is around 11 point something billion. The next thing that is closest to that will be interest on income from government securities, which is around 3 billion. So you are saying from your largest income item on your P&L, you have cut 25%, 50% of it for the next 6 months. This now then, as a bank trying to manage your balance sheet and manage your profits, you sit and think, as much as I have given a moratorium and extended or restructured most of my loans or 50% of my loan book, you are actually not quite sure whether that extension is long enough, because the items that have made most of the companies that have asked for restructuring, and from the data that we have is that most of it was the tourism sector and the hotel sector. Those things will not have gone away by the time we reach December. And for some hotels, they might actually not even come back up again. Some sectors will remain dead for quite a while. That means after that moratorium period, IFRS 9 has to kick in. They either have to provision or they actually have to write off. So when you are a bank and you're thinking that you have to write off or provision, then now the question comes in, do I have enough capital to absorb such a huge loss on my book? Using again KCB as an example, they have shareholder funds of 98 billion, 3 billion of which is revaluation reserves, so it's not really money. So their loan book actually is around 94 billion. So most banks now start saying, if I was going to pay out 5 billion or 6 billion in dividends, I will rather retain that so that I increase my window between core capital and my asset, my risk-weighted assets, so that I can absorb any forthcoming provisioning or forthcoming loans that are going to come in. So just using the banking sector, that's an indicator of that the banking sector themselves are feeling like their loan losses are going to increase in the near future, and that's why they're trying to hold on to cash as much as possible. So COVID has played a part, and some of the policy measures that have been put by the government to try and cushion Kenyans are going to hit banks going forward.
Wow, that's quite an elaborate answer. What you're really saying is the fact that COVID has actually happened will have an impact on different sectors. And supposedly that's, I mean, it is prudent to be able to put money aside. We have seen Equity Bank do that. When you look at the banks, and perhaps you're more familiar with the ratios and in your engagement with the bank executives, do you get a sense that of any other bank that could possibly do this over and above what Equity and NCBA have done?
I think most banks would do that, because the largest bank in terms of balance sheet is KCB, then your Equity, then your cooperative. And if Equity has done that with such a balance sheet, then you would know that most banks will be in such a situation. So when people hear that a bank has a balance sheet, again, I'll use KCB, has a balance sheet of 768 billion. You need to know that of that 768 billion, in the case of KCB, their own funds, the shareholder funds, are only 98 billion. Remove revaluation reserves, it's only actually 94 billion. So the rest is funded by customer deposits, which for KCB's sake is around 568 billion. So if a loss is to happen, they cannot offset that from customer deposits, because that's already a liability. They can only offset it from shareholder funds or the other assets that they already have, which is investments in government security. So with a balance sheet of 91 billion versus loans of 468, they don't have enough room to actually absorb losses that would come if they would write off, let's say, 20% of their loan book. If KCB is to get a run on their deposits and you have already written off 20% of your loan book, you will realize even the shareholder funds are not enough to cover the deposits that if everyone is to come for their deposits at the same go, they will not have enough shareholder funds if they suffer close to 20% or 30% loss on their book. So most banks most probably will hang on to cash at this point in time, or seriously scale down on lending to the private sector to try and reduce any further risks that might come to their loan book or the quality of their loan book.
Now, the absolute number in terms of the shareholder funds for KCB, I was going through the numbers for Equity Bank, or rather Equity Group, and their numbers were 111. But of course, when you make the adjustment for the 9.4 billion, it becomes a bit lower. But you bring out a very interesting concept, because if you're saying a bank that has shareholder funds of 111 and is much smaller, I mean its loan book is smaller than the loan book that we've seen with KCB, then there's possibly a read-through for some of the other banks such as KCB. But the other thing that I noticed when I was just looking at the shareholding, because I figured, you know, KCB has the government of Kenya, that's either 17 or 19%, I'm not too sure the number is there, but that's about 17-19% ownership by Treasury. And you have a government that needs the funds from dividends. So you could have a situation where, yes, it's prudent to hold back this dividends that you had proposed to pay, but some of your shareholders would possibly have influence on that decision at a board level in terms of extracting that value. But I give that context to ask this question. When you look at the shareholdings of some of the banks that you look at on a regular basis, and also look at the board constituencies, are there some banks that sort of have more government exposure, which to me could indicate that the dividend outlook or the dividend payout could be steady compared to some of the other banks?
I guess when you look at the shareholding structure in Kenya, you will have on the listed banks, you will have KCB and NBK, which literally doesn't exist anymore, as the one that the government has most shareholding. Then away from banks, then you'd look at your KenGen, Kenya Power, Safaricom, and Kenya Re, and the other government institutions that have been listed. So on banks, yes, for KCB, for example, if the government really needs dividend, most probably they would pay. And the benefit of having the government as a shareholder, again, when you do a stress test for a bank on the ability of a bank to absorb a shock, you also look at the ability to be able to raise capital very quickly, or to up their capital. And having a government as a shareholder, government can literally print money and give you to try and cover any losses that you're actually going to make. So banks with a government shareholding will have both sides of benefits. The ordinary shareholders who are not the government shareholders will benefit because the dividend most probably will be paid, but also the bank stability is also kind of quasi-guaranteed because if KCB does a cash call and things, I think the government will definitely come through for them. They just need to do a rights issue. That's where now the private shareholders of other banks, you wonder, do they have the capacity to raise 50, 40 billion if their banks do a rights call or a cash call on them, or may they be forced to actually borrow now at higher rates because of the change by Moody's on their credit ratings, would be able now to borrow maybe at a more expensive, which will affect future cash flows for those banks.
Bring in a very interesting concept in your analysis there, because typically what we're saying is now if you're in the NSE and you're looking for a defensive strategy, now it's not really the dividend yield, it's perhaps who's a holder. And if the government of Kenya is a holder, that could be a possible tactical defensive strategy for you. At least that's my read through from that. Let's look at some of the other companies. Kenya Airways announcing its results. Of course, we expected them to announce a loss. But where's this loss coming from? Because you have a company that's generating over 120 billion in revenue, but there's a lot of leakage in between. Does this company, whether it's operational or not, will it still keep losing money? Is it worth anybody's investment time in terms of going through the numbers and trying to understand where the leakage is coming from?
If on Kenya Airways, if you have an organization that is able to generate revenue and that revenue is growing, ideally that is actually a good business. Because KQ's problem is that it's not that revenue is dwindling. The revenue actually has been growing. What they need to get a hold on is their operating costs. Then when you look at operating cost of an airline, what is the major operating cost of an airline? Number one is fuel. Number two is their staff in terms of pilots and cabin crew and all the stuff that goes around there. Number three cost is landing rights and taxation. So if you look at an airline and they cannot get hold of their costs, then you see where is the leakage in terms of costs. Is it on oil prices? And I see that they've made money on fuel hedging. So clearly they seem like they're getting hold of how to manage oil prices in the market. Then you go to the next cost, which will be staff costs. Are their staff costs or operational costs comparable to the other regional players in the market? Because these costs also feed into the competitive nature in terms of their pricing. Because you have to make your pricing is determined on your cost. If you do your cost accounting, definitely you have to be making a profit, so you'll have to put a margin on top of your cost. So I believe for Kenya Airways, yes, the nationalization route might be a good route for them to get them back into a proper footing and maybe able to manage the element of the costs. But if they nationalize and they still don't address the element of the cost of operating Kenya Airways, then it will become another loss-making parastatal. And I believe if they get the right skills on managing the finance side of the business in terms of fuel, in terms of staff costs, and if the government now, if it becomes a parastatal and gives them the right incentives in terms of taxation, then Kenya Airways can easily pick off from where they are, because they have very good roots. They have a good name, and they can also ride on the name of the country and the goodwill and brand of the country, Kenya, that they currently have, and move on from there. But if they can't manage those four things, and I believe the new CEO has an advantage after coming from GE and having the skills that he has in finance, should be able to manage the element of the fuel cost and the operational cost. The government really now needs to chip in and reduce most of the taxes, or even give them a tax break for a while until they get back on their feet, and then you can start taxing them going forward.
Thank you so much for that. Would you have a sense why we are seeing other African carriers, such as Ethiopian Airlines, facilitating cargo transfers and sort of acting as a go-between China and Latin America, is that an opportunity that's exclusive to them? Is that something that Kenya Airways can be open to in terms of looking for different revenue sources? Or really, what's the comparative advantage that Ethiopian Airlines has over Kenya Airways? And I'm looking for a very generic answer because I'm sure we haven't, at least I don't think you cover it because you're not, that's not part of your investment mandate. But off the top of your head, what sense do you get from that?
The comparative advantage that Ethiopian Airlines have is one, they have ridiculously lower operating costs and a huge capacity. So for example, being agile and nimble during these times actually helps. Instead of parking their aeroplanes, Ethiopian Airlines converted most of their Dreamliners into cargo planes, removed all the seats and started flying cargo. As other airlines shut down and cargo became the highest demand in moving things, PPEs and all those things from China to the other countries in the world, and including Africa, and even moving things from Kenya itself to the EU has helped them. And I think as a business model going forward, it's something that Kenya Airways might actually need to think of, because cost-wise, running a cargo plane is cheaper than running a passenger plane. And if they can start playing that, especially the inter-Africa route, there's a lot of trade barriers inside of Africa, and one of them is infrastructure. How do I move cocoa from Ghana to Kenya cheaply without it having to go to Europe or Asia to come back on a ship? And it actually literally came from Ghana. And the cost of freight inside the continent is normally so high. So for KQ, instead of even thinking of China, Latin America, a business case for them might be, how do we do cargo in Africa? How do we build capacity from 2 cargo planes and have more cargo planes that play the Africa route, or that do China and the African continent? Might be a good way to build the competitive advantage over Ethiopian Airlines.
Much for that overview. And for you, our viewers, our general manager Terian Chebet did have a one-on-one interview with the chief executive officer of Kenya Airways. She has you can find this link on our Metropole TV page. It will be worth your while just to understand what is the thinking, what is the strategic thought process in terms of what could happen for Kenya Airlines. I certainly invite you to be able to watch that. Now, moving to the other segments of the NSE, Reginald, we have banks that are possibly going to say they're going to cut back their dividends, either give you a bonus share or cancel in totality this dividend. We have other blue chip companies, such as East African breweries, coming out and giving cautionary statements for their earnings. We are sort of in the sense where earnings for the next year expected to come off. Is there a point of recovery? And what I want us to get to is, should you even be putting your money on the securities exchange today, given what's happening at a global level, at a macro level, and at a micro level when you look at the specific counters?
Putting money in the NSE is now determined on whether you are a short-term investor or a long-term investor. For long-term investors, yes, this historically looking at the valuation of the NSE and where we currently are, looks attractive to go in. For short-term investors, have we hit rock bottom yet? I do not think we have actually hit rock bottom in terms of seeing earnings coming down and therefore prices also coming down. We've also not started to see foreign investors coming back into the market, who are the ones that normally drive short-term bursts in the market, which gives quarterly traders or monthly traders a 5 or 10% moving there. And with all these regulations on taxing dividends and capital gains for foreigners who are coming to the market, might also start making the NSE not look that attractive. Also, the direction of the exchange rates also will determine when foreigners will come in or how they will come in. So if you look at the valuations of the companies on the NSE, a company cannot literally outperform the economy that it operates in. The same way you have seen banks' bond holdings or banks' credit ratings suffering because of where they've invested in. So it cannot be greater than a sovereign inside a sovereign. So if someone is investing in equities, what are the methods that you can use to value equities? You can use your PE ratio, your dividend discount ratio, your free cash flow ratio, and all those measures of valuing a stock are all determined on the required rate of return that a person is expecting from that stock. And when it comes to equities, we normally use CAPM, capital asset pricing model, to come up with the required rate of return. So as an investor, what is your required rate of return? It's a function of the volatility of the stock measured by beta, your risk-free rate, and your market risk. So then when you look at those components that affect the required rate of return, to know whether I am going to be able to get enough return from buying EABL at the current price or buying ABSA at the current price, then you look at what affects the risk-free rate. The risk-free rate is affected by one, inflation expectation. It's affected by the economic outlook. It's also affected by money supply and the budget deficit of the country. So if you look at those things, if you look at the factors affecting those elements, you will say that we'll see a gradual increase in the risk-free rate of in Kenya from where it is currently. Because of that increase in the risk-free rates, you will expect also the market risk to also increase in the coming months or in this coming period. What affects the volatility of a stock? The volatility of a stock is affected by one, surprise earnings. And that's what we are seeing right now when you get blue chips telling you 25% profit warning. So that's a surprise earning. So you find stocks start becoming a bit more volatile. So if you put all those together, the required rate on equities right now would most probably go higher than it was in last year or it was in January. Then the question comes, will the return that the stocks are going to give in the next 1 year or 2 years meet that required rate of return? I do not think so, because earnings are coming down. That means also cash flow from dividends is going to reduce. PE valuations are also going to reduce. So you will not be able to get the required rate of return that you would get. So the activity that you've been seeing in the NSE right now, even as it is currently in this quarter, has gained and has gone up, is because as long as the central bank pushes rates lower and tries to force low interest rates on the market, money will start flowing into the NSE, trying to look for a higher yield. And what that creates is a stock market bubble, because you have investments going to stocks which are not based on any fundamentals whatsoever, based on the definition I've given on what a required rate would mean and what affects those elements of the required rate of return. So if the NSE continues going up, then we can safely say we're entering a stock market bubble, and we'll be waiting to see what will pop up that bubble. So if you're investing for a long term, yes, you can go into the NSE. Timing becomes important. But for short-term investors, cash is king right now. I would rather be in interest-earning securities.
Just take a brief break. When we come back, I'll come back and evaluate what long-term and short-term means. We take a short break. Let us know where you're watching from or what questions you would like to ask in as far as investing on the securities is concerned. Our SMS line is 20146. You could also reach us out on our social media platforms. That's at Metropole TV Kenya or at Mbithe Mwema. We will see you after the break.